Welcome to the ACA conference in New York City. I'm Jane King, and with me is Nishil Mehta of Carlyle, Managing Director there. And let's just start by what's Carlyle. A lot of people have heard of it, but maybe don't totally understand what happens there.
Sure. So, yeah, as you said, Carlyle is pretty well known, but so Carlyle is a leading global investment firm with about 450 billion of assets under management. And it's across three key areas. It's private equity, which has really been our historical focus, credit, and investment solutions.
Okay.
Now, credit, which we have a 25-year track record in, is now $200 billion. It's actually our largest strategy today, which most people don't realize. And within credit, we have four key areas that we focus on. One is liquid credit. So that's really focusing on the collateralized loan obligation market, CLO market. We're the world's largest CLO manager there. Two, we have private credit, which is direct lending, which a lot of people are familiar with, and then opportunistic credit. The third area we focus on is real assets. So that covers infrastructure, that covers aircraft leasing, that covers real estate credit. And then the fourth is asset-backed finance.
Interesting.
Yeah.
And you are in the credit portion of the business. So talk about how you see the credit markets right now.
Yeah, so the credit markets, what's been interesting is you've seen a real removal of uncertainty with the election behind us. I think markets hate uncertainty, and there was talks about it taking days, weeks, maybe months for a final election result. And now that you've seen that in the rearview mirror, that certainly has allowed the markets to really rally. So that's a big positive. Two, you've started seeing the Fed start cutting rates, which obviously reduces the cost of capital, and that's positive to markets as well. And then three, I think fundamentals continue to be strong. If you look at just the government indicators, we look at the macro indicators that we see within Carlyle. We have a chief economist who looks at the performance of our 290 portfolio companies and shows that performance continues to be strong, or even in our broadly syndicated loan exposures. We manage 50 billion of it. We get financial statements on all those companies, about 600 to 700 credits. And on a quarterly basis, you're seeing revenue growth of 5-6%. You're seeing EBITDA growth of 8-9, high single digit. So we're seeing strong growth there. And so we're pretty positive on the overall fundamentals within credit. The one thing that obviously is a big unknown with the regime change is you're going to have a lot of policy changes, and a lot of those policy changes could have inflationary impact, especially tariffs. And so it'll be interesting to see where interest rates are a year from now, because I think where the market's expecting rates to be versus where they might be in a year from now might be divergent, which I think over the past 3 years, that's been the case. I think the market's been surprised by the Fed every time, and so it'll be interesting to see what happens there.
Yeah, the Fed seems so hard to predict. It was like it's transitory. Then it was longer for, higher for longer, and then, soft landing, and there's a lot there. So when you look at to 2025, what are kind of some of the things on your radar screen that you're going to be keeping an eye on?
Yeah, I think one, with just this uncertainty behind us, you're definitely going to see an influx of capital markets activity. I think over the past 2-3 years, you've seen subdued activity in capital markets, and private equity, and with potentially rates declining and maybe a more business-friendly regime, I think you're really going to see activity pick up. When we speak to our teams within private equity and capital markets, they're talking about how they're expecting activity to pick up. When you speak to bankers and M&A, they're seeing activities really picking up. Now, that activity, typically there's a 3 to 6 month cycle. So you're not really seeing that activity pick up yet, but with the expectation, I think there'll be a big tailwind, especially for firms like Carlyle, where we are one of the largest private equity firms, allow us to have a little more realizations and give some money back to our investors who've been patiently waiting. So that'll be a big positive as well. And then two, from a credit standpoint, when you have all this capital markets activity, those typically need financing. And so you're going to see a real influx of financing opportunities. And that's probably up and down the spectrum. When you think about the broadly syndicated loan markets, where you're talking about companies that have earnings of $700 million, all the way down to the private credit space where we focus on as well, 20, 30, 40, $50 million of EBITDA as well. You're going to see an influx of opportunities. And so I think that will level out some of the supply-demand imbalance that we're seeing today, because right now you're seeing a lot of demand for products and there just hasn't been as much supply. So you've seen a real spread compression this year, and so we expect that to kind of level out in 2025.
Okay, Nishil, thank you so much for sharing your thoughts with us.
Thank you.